Hello everyone, my name is Vikas Agrawal and I am the founder of AIF and PMS Experts India. So AIF is your alternate investment funds and PMS is portfolio management services. Well, I'm discussing this because some of you I can see have joined here for the first time. So we are one of the largest platform for investing in alternate investments and portfolio management services. So if you wish to know more about us, you can visit our website www.aifpms.com and you can book a call with the team of experts and they will help you and reach out to you and sort of give you all sort of analysis what is required before investing. So at AIF and PMS Experts India, we keep organizing these knowledge-based sessions, and the whole idea of organizing this session is to sort of educate and empower the investor community as a whole by inviting industry experts. And with me, I have someone who's very, very good at equities, and his name is Chockalingam Narayanan. He has been in equity markets for over 17 long years now, and mainly into equities. So, he has worked with large organizations like Baroda, BNP Paribas Asset Management Company, Deutsche Equity India Private Limited. He has also spent some time with Karani Securities. So academically, if you look at, he's a postgraduate from TA by Management Institute and he's Bachelor of Commerce from GR Damodaran College of Science. He's also completed his Financial Risk Manager FRM certification by Global Association of Risk Professionals, USA. And he's been working with ICICI for quite some time now. And so today what we'll do is, we'll try and read his mind, understand where are these businesses which were like down by good 30% 3 months back and have recovered very fast. So we'll try and read his mind and understand whether it makes sense to get onto equities at this point of time, or it is good to be sideways. So we're going to have detailed discussions. It's going to be very interesting because Chockalingam is known for picking up some of the companies at an early stage of their growth curve. His visionary eyes really helps him to identify those companies much earlier than some of the mutual fund companies or PMS companies, think about picking those businesses. And sometime I have seen that he is able to ride through those growth journey also, in the sense that he may not sell early. He might wait for valuation to get over and then, probably think about replacing that. But if needed, he might sell early also. I mean, it purely depends on the valuation and the proposition that market reveals. So keeping that in mind, and he comes from an analysis background. So he himself was research analyst. So he would know, how do you bring those ideas? Because when you are doing a complete research before you become fund manager, obviously you bring those advantages and expertise on the table. So hello, Chockalingam. First of all, very much. I mean, thank you so much for accepting a request and taking the time out from your busy schedule and agreed to speak to all our investors today.
Vikas, very kind words and for the introduction. And thanks for the opportunity. Very good afternoon to each and everyone present in the session. Vikas mentioned about the markets and the outlook. I'll try to cover some of those aspects as much as I understand about it. Volatility versus risk is something that one needs to understand and appreciate. So if you kind of look at the Indian equity markets, it has in the long run kind of tended to kind of mirror what's happening in the underlying economy. And that has reasonably done well. And to that extent, what we've seen, the longer term journey has been reasonably good. But it does come with its ups and downs. It is not a linear journey. In any, even the best of the bull runs, you will have amount of drawdown. So if you, for example, look at the 2005 to 2007 bull run, for example, which was one of the best ones that we've ever seen. I particularly remember in 2006 we've had drawdowns of more than 10% 5 times. So it's not out of the ordinary that you will see a fair bit of volatility, because that's the nature of equity investing itself. Reason is you're a co-owner in the company as an equity investor, and to that extent you will see a reasonable amount of volatility as you see with the earnings whenever any of the the business kind of changes. So what this graph also tells you is time in the market is a lot more important than timing the market. Yeah. So that's again something people keep asking: Is this the right time? Is this the right time? That's kind of a very oft-repeated question that we typically find. But if you have a 4 5 year sort of a horizon. Typically, for a growing market like India, especially given that we have a working age population that kind of continues to see a bit of growth, the next 15 years that seems to be reasonably okay. I think we're in a market which is giving you a reasonable amount of tailwinds to participate in growth, and to that extent, we are reasonably poised. And to that extent, I think if you come with that kind of a horizon of say 4 to 5 years, then equity, again, I repeat it, time in the market is more important than timing the market. Can you get rid of volatility? Absolutely not possible, and cannot be controlled also. It can move for various factors. But what you can need to and focus on is we need to focus on ensuring that there could be temporary risk to capital, but that those should not become permanent. Now that's the effort that one needs to put in and understand that what can cause permanent risk to your capital, and we need to guard against it. If there are temporary ones, then those are actually good opportunities to participate in longer term growth opportunities. That's something that we inherently believe, and this is another core belief of ours when we evaluate businesses. Is that companies create wealth, not markets. It's not because markets are doing good that certain company stocks do well. It's because certain companies are creating wealth that the markets, as a result, actually move up. So it's not the other way around. And you can actually see it with data. If you actually take between 2010 to 15, which was a pretty tough environment for returns, the bottom row in red is the Nifty 500 returns during each of those years. What you will see is if you actually take a bucket of 5 years and 5 year CAGRs, in that low return period also, you found on an absolute basis 15% 5 year CAGR being generated by anywhere between 77 to 56 companies, which effectively means between 15 to 52% of the companies generated an absolute return of 15% 5 year CAGR, irrespective of what happened in the market. Now, that's precisely what we're trying to say, that there are always a certain set of companies which will figure out a way how to navigate those issues and who can actually turn some of those headwinds into opportunities and kind of participate. Now, how do we identify them? For any stock, typically you tend to focus on, the price of a stock is dictated by EPS into PE. So for a stock to do well, there needs to be earnings growth or PE improvement. If both are there, then nothing like it. It's ideally the best combination that's possible. Now, if you kind of look at where the markets today are, I think if you take the last 2.5 years, we've kind of had a bit of a run, but that's come largely on the back of massive earnings growth. If you actually take that into account, then earnings on a rather PE, we are at around the average levels. It's not actually too expensive in that sense. We're slightly above average is what I would kind of say. Looking at the second aspect that one needs to look at is if we actually go around and look at what really drives stock returns for companies and kind of bucket companies into companies delivering more than 15% CAGR returns, or those delivering between 0 to 15%, or negative 15 to 0, and into those kind of buckets. What you will see is for the stocks doing well, one, earnings growth is very good, which is PAT growth. Second, the ROE improvement or sustenance of very high ROEs is something which is quite crucial. And if they are able to deliver these two combinations, and we at our end get them at a reasonable starting multiple, then the amount of wealth creation can be actually quite superb. The second bucket of companies is more common, where they grow earnings quite decent in line with what happens in the economy. Their ROEs, while it drifts down, because there is earnings growth, the PEs kind of remain where they are. The third and fourth bucket of companies are those where profit growth is under risk and ROEs are also trending down. those are recipes for disaster, and those are the ones which where you actually destruct wealth. So those are the ones against which you should guard against. So ideal combination is the first one. Second one you'll always find a lot of companies that you would pick that would be there in the second combination also. But what you need to focus on is aspect as choosing the right set of companies. Guarding against wealth destruction is as much a part of the journey as much as creation of wealth. So that is something that we do. Now, big advantage for us at ICICI Prudential Alternate Investments is we have a very big research bench strength. We have roughly about 22 analysts covering 490 stocks. That's unparalleled in the country. Even the largest broker in the country kind of covers only 345 stocks. Against that, we actually have an in-house team which actually does 490 stocks. So anywhere and anything that kind of sees a earnings improvement or ROE improvement, somebody within the team kind of has an eye on it, and that really helps us opportunities better than. The other area that we, obviously, the team here, headed by Mr. Anand Shah, 23 years in the market. Myself, 18 years in the market. My colleague Gitika has been in the market for 16 years. The three of us manage funds. In addition to that, we have analysts, two analysts who do slightly more deeper work to the 22-member research team that kind of does more sector stuff. These guys also help us do slightly more detailed work to build more concentrated positions, because AF and PMS, we also give that boutique experience. So that's also required. So that's the additional element that we bring in. And then we have a very seasoned dealing team in Dhaval and Preeti with each between 15 to 20 years of experience. And we follow a process called BMV. This is the funnel through which we kind of pick literally every stock that kind of comes into the portfolio. It's a 5-step process. Initially, you have the 2,500 odd stocks that are actively trading in the market. From this, we have active coverage on close to 490 companies today. From this, we apply the BMV filter. What does BMV stand for? It basically stands for business management and valuation. So here we are ideally looking at businesses which are growing at a rate faster than GDP of the country. Second, they are growing at a rate which is better than the industry in which they're operating, which effectively means they are market share gainers. And three, they have certain advantages as far as concerned, which is called moats. All moats erode over a period of time, but then we need to see if there are companies which kind of reinvest into that moat and are strengthening it. If there are companies doing that and expanding on it, then that's actually much better. We look for those kind of businesses. Second, we look for managements. First thing we look for a management is capital allocation, because end of the day, your investors allocate capital to you. You allocate capital to people like us on the asset management side, and we in turn allocate capital to corporates. So that's the heart of the function that all of us do. So it's quite important that the managements actually do a good job about it. That's what we focus on. Then we look at what's their execution track record, what's their competency, have they been credible about whatever they've kind of called out in the past, do they follow good corporate governance practices? We look at all those aspects. After doing this, filter on B and M is when we actually go into valuation. Valuation is something that is a last step. We don't start with valuations. That looking at a company, looking at this company is cheap, we'll go into this. We don't do that. We actually do B and M first, and then if it filters through, that's when we get into valuations. Within valuations also, we kind of look at the financials in terms of not more from accounting earnings based valuations, but more from a cash flow based valuations. So we lay a lot of emphasis on the balance sheet and cash flows a lot more than P&L. So that's something that how we do it. So this is the third step. Fourth step is the strategy level filter. So for example, today we have Contra, Pipe and FlexiCap as 3 strategies. So Contra is basically out of flavor sectors. We pick leaders That's typically, because when we pick them when they're out of flavor, we get them at a decent risk reward. So when things turn, you actually make decent money. And eventually, when there is a bit of momentum to the business, which takes it slightly more also. So that one leg is helps you generate reasonable amount of wealth. That's the idea behind Contra. Second is pipe. It doesn't have any investment style like Contra. It could be growth, it could be value, it could be growth at a reasonable price, it could be any of these styles. But it has to be small and mid cap. In Contra, we could pick large cap, mid cap, small cap. It could be any of the market caps. But in the investment style is Contra. Whereas in pipe, the investment style is not there, but we predominantly invest only in small and mid caps. And finally, FlexiCap. It's a it's a growth at a reasonable price sort of a portfolio in terms of investment style, and it invests in large cap, mid cap, and small cap across the three categories of market caps. From this, so from the 100 odd companies which filter through PMB, depending on the mandate, we get anywhere between 40 to 50 companies for each of the strategies. And from that, we actually build an eventual portfolio of 25 to 30 stocks. This is how we pick stocks. And in each of our strategies, when you kind of look at it, you'll find between, like Contra has 23 names, Pipe has FlexiCap has 28 names. The active share versus index is, pretty high. This is what we stand for. We stand for our original research. We stand for our huge underweight, overweight positions, and we show our conviction through the high active shares. So that's predominantly what we stand for, but we do not do it through pretty unknown names. We actually do it with pretty large index names itself. So if you kind of look at the Contra portfolio, for example, 19 out of the 23 names are actually part of the BSE 500 index. Similarly, in the pipe strategy, 14 out of 29 is actually part of the for BSE 500 index, and about 25 out of the 28 names in the FlexiCap strategy are also part of the index. So it's predominantly names that are known, but through weight management, we actually create a lot of alpha that we are able to pick a theme slightly early and then participate when the theme actually plays out. So that's how we do it, but it's more bottom up. It's not top down. So that's what we do. Looking at the markets, we've had a fairly good earnings growth after almost 5-6 years of stagnation in terms of earnings. But a broader theme, there is two large themes which are running out there. One is that globalization is reversing, and second is inflation is basically sticking at a level which is higher than before, higher than the pre-COVID levels. So for about 15 years, actually 30 years, the inflation was at about 2% in the developed world. That seems to be settling at a higher level for now. And second, globalization is basically seeing a bit of reversal because there's clamor for local labor. So which is basically meaning that local jobs have to be created. So which is why supply chains post-COVID, which were earlier, there only in the global supply chain, meant capacities were predominantly in China and were supplied into other countries. Today, the people are moving from just in time to just in case. So as a result, we are moving from a global supply chain to a mix of local supply chain, friendly supply chain, and global supply chain. So it's no more just global supply chain, which effectively means there is a chance for local companies to also participate in the growth, which historically was challenged because of the uneven competition from China. Alongside China, we also had a lot of private equity and venture capital funded loss-making companies which used to come and disrupt the profit pools of companies. Today, that is also because the inflation levels and cost of capital basically moved up. That uneven competition is also no more. So as a result, you're basically seeing improvement in profitability, particularly for the B2B companies, because that's the space where this uneven competition was a lot more acute. B2C companies are continuing to grow at a decent rate, but B2B is where the significant improvement in profitability is. Against that, the market cap creation in this space has not been that commensurate. When you actually look at earnings growth, pre-COVID versus post-COVID, The significant improvement in profitability is actually come in areas like corporate banks, infrastructure companies, metals, commodities, energy, and to a certain extent in IT. But when you look at what's happened to the valuations in these sectors, barring IT, every other sector has actually got derated. So it's quite clear that a lot of these sectors which have seen earnings growth haven't really participated as much. But when you actually look at long run, this is the data that we kind of saw earlier that typically markets
Re-rated or they're derated? Sorry.
They have actually re-rated. But today, if you kind of look at what's really happened with the markets, the sectors where earnings growth has been. So, for example, the sectors that I called out here, they've actually had decent earnings growth. But when you look at their PE, they've all actually got derated. So if you look at banking versus 19.1, it's gone to 15.6. Infrastructure is barely at the same level. Commodities 14.7 to 13.5. Metals 13.9 to 11.5. Energy 12.4 to 12.1. So either they're at the same level or they've actually got derated. So effectively, that's a big this thing that so if these companies can actually sustain
valuation point of view, it makes sense, is it?
Yeah, more than valuations, it's actually the earnings momentum which is there in some of these areas is actually significantly better. That's not being fully appreciated in the market. So when there is that earnings momentum, ROE improvement can be quite significant, and that to that extent is not fully reflected in the markets, which is where we see an opportunity. And particularly, what we are also seeing is incremental market share is shifting to the stronger companies. Sector after sector, you're actually seeing examples of this. And which is where today, if we bottom up look at opportunities, sector wise, these are the areas where we are actually finding risk reward being reasonably positive, which is basically more manufacturing businesses like aerospace, defense, textiles, auto, chemicals, metal, or manufacturing allied businesses like industrial products, utilities, banking, corporate banking, and logistics. These are areas where we are finding a decent risk reward. So if you kind of look at the portfolios, all three, you will see a significant tilt towards the manufacturing plus manufacturing and allied businesses. So versus the index levels of manufacturing allied being at about 20%. In FlexiCap, we have about 45%. In Contra, we have about 54%. In Pipe, we have about 62%. So these are significant departures from the index in terms of the sectoral weights. And if you look at, say, strategies like Contra, we do not have, IT or pharma. We do not have too much consumer staples or discretionary. We actually have only capital-intensive consumer companies like telecom or real estate. And within financials also, we own a lot of lending companies, particularly corporate lenders, than anybody else. So that's the way orientation is there. In Pipe strategy, on the other hand, financials orientation is a little less because strong franchises within financials are found a lot more in the large cap space. In mid and small cap, you actually find more niche companies operating in niche segments or in niche geographies. So to that extent, the orientation of that space, sector within the Pipe strategy, because it's very small cap and mid cap focused, we don't have as much as what we find in FlexiCap. But you do find a lot of bottom-up manufacturing and manufacturing allied businesses within the small cap, mid cap, which is why the orientation of that particular part is a lot more. Yeah, so that's broadly what is there. This is the portfolio today.
This is the earnings. We'll have a discussion about each and every portfolio. So it will be more in a Q&A format. So maybe you cover up your market outlook if there is anything that you want to add, and then I'll come to the strategies.
Yeah, I think largely we are done with the market outlooks. If there are any questions on that aspect or any of the portfolios, we can cover it accordingly.
Yeah. So a couple of questions. One, we saw that a good amount of recovery happened broadly in mid and small cap vis-a-vis large cap. So what's your sense on that? Like where was the value and where do you see more value coming?
So if you kind of look at the earnings growth also here, you can quite clearly see Pipe strategy, which is a more small mid cap portfolio. The earnings growth within the or if you actually take the BSE 500 and Nifty mid and small, for example, that's kind of quite clear that the earnings growth has actually come more in the mid and small cap. So which is where the improvement has also been significantly better versus the top 100. ROE improvement has also been significantly better for this particular cohort versus the large cap space. That's why it's had the kind of move that it has had. It's driven by that. Our portfolios also, we've kind of kept the same theme because historically that's what the market follows in the long run. And hence, what is there. But despite that, our portfolio, even after the large outperformances, is still available at a very, very reasonable PE, starting PE, even for today, if some investor were to come.
Sure. The second question is, we saw a very good amount of recovery happening in pipe strategy, particularly. Of course, pipe has been doing fantastically well for the last couple of years. Can you talk to our investor and tell us more about the history of the fund? Because I remember this fund was launched, I think, in 2015, then got closed in 17 because you were not comfortable with the valuations or something like that. Then again started in 18. So can you talk to our investors and throw more lights over there?
Yeah. So before that, on the earlier question also, what I'd also like to kind of mention, we don't bucket things too much into just because the stock is large cap, mid cap, or small cap. We look at it in a different way. What we do is we do it on a bottom up basis. What's really there, and if it makes sense, if the risk reward makes sense, and if it filters through the BMV quite well, that's when we bring it into the portfolio. So that process is a lot more core and inherent to us rather than looking at just whether it's a large, mid, or small, where the risk reward is better at an index level. Now, as regards pipe, yeah, you rightly mentioned. This strategy, we've kind of had it. The first version, Pipe One, we had it launched it in 2013, and then for the original investors that came in 2013, we actually gave a return of about 370%, and then 2017 December we announced we gave back the money, and in 2018 January we actually gave back money and closed it because we found the valuations risk reward quite unreasonable at that point in time, lopsided. That's why we gave back money. But then subsequently in September 2019, when the risk reward again looked better, we've kind of relaunched this. This is in its second avatar. So even today, if you kind of look at this particular fund, whether it is 6 months, 1 year, 2 year, 3 year, we've actually done pretty well as regards the strategy. So is the case with even Contra and FlexiCap. So we've done pretty well. Here the orientation that we kind of took here were the companies that we picked incidentally happened to be in small cap as per SEBI classification, but they were actually quite large businesses. They were not the thesis behind this were, if you typically pick any of these companies, they were leaders in a small category, or they were fast growing challengers in a large category. So if you, for example, take the financial companies here, the banks were focusing towards a very niche area like SME, or they were focused from transitioning from a microfinance institution into a more diversified financial franchise. And when they diversified their CASA franchise on the liability side quite well, the structure of the book and growth was looking quite promising. And for that risk reward, the bank was actually available quite reasonable for that strategy and execution. The bank's valuations were actually quite cheap, and particularly the holding company was there earlier. So and there was a 20% discount on that as well. So we played that through the holding company, and eventually the RBI approval came across, and it got folded in. So that's how some of those entities were. Second is, say for example, the leader in parcel logistics, which is basically non-time sensitive cargo. We bought into the largest company in that particular sector. Then within large sectors like metals, we bought the companies which had the iron ore or coal integration, because they had access to mines which were long ones and low cost mines, and they had balance sheet repair which was going quite significantly. So there was huge growth. That basically meant, so just I cite this example quite often. So there are 4 or 5 companies in this portfolio with an EBITDA between 1,500 to 2,000 crores, but with a market cap between and all of them having net cash, but market caps between 4,500 crores to 10,000 crores. Yeah, all net cash balance sheet. So which effectively meant these companies were available at 3 to 5 times cash flows. Now, but while these most companies that I'm talking about are B2B, we did find B2C companies with the same amount of profitability being available at 1,40,000 crore market cap. Okay, so that's the sort of dichotomy in terms of the market cap versus the profit pool. So we didn't think, while we didn't ever think that the B2B companies would be as much valuable as B2C, we did understand that the risk reward and the dichotomy in valuations can't be this large. So we thought eventually this has to correct. So as long as the cash flows are steady, the earnings improvement is there and ROE improvement is there, these are names that one could participate better. So that's what we've kind of picked. Then we were early to certain themes like the shifting of supply chains. So basically, when the bearing companies were moving capacities to the country, the tier 2 suppliers to them were big beneficiaries.
Yeah, I was coming to that. In fact, when you say that you're a bottom up guy and you would look at stocks individually, but when you look at the overall portfolio, this is just one query that I have, which if we can clarify, that I can see manufacturing and manufacturing allied both put together is more than 50-55% of the portfolio. So this is by design, or this is by doing the complete bottom up and then looked at the outcome, and outcome turned out to be like this?
This is outcome. This is not. This is by following companies wherever there is earnings growth and ROE improvement. It just so happens that where this is we are finding it more often is more in manufacturing and manufacturing allied areas. We are not going top down and looking for that particular aspect.
Sure. Okay. So you would have looked at those businesses. Their businesses are growing and they're pretty large, and you looked at their 3 to 5 times. So when you started designing, then eventually turned out to be like this. Because why am I asking? Because this is a more looking like manufacturing theme, so hence I am asking and trying to clarify this.
Yeah. No, but we did see emerged because when we were tracking these numbers were stacking up the way it were. So then we try to understand what are the common themes which are running across parallel to all these stocks. So that is when we pinpointed and put it as manufacturing, and then are presenting it to you. So it's a more bottom-up journey.
And also, Chockalingam, if you can talk to us about 2 things. One, about your fund management team, because essentially you look after the PMS pipe, whatever little I know, and then Anand also, overhead, he would look at as head of equities, look after the entire strategy. But can you also talk to us about who looks after this strategy in your team, and how many analysts have been working along with you?
No, sure. So this is the team, for example, within PMS. So team headed by Anand Shah, he predominantly looks at Contra and pipe. We both do the co-management of Contra and pipe, both the portfolios. Then I run flexi cap, large cap, and value strategies, along with again Anand and Gitika. Gitika runs the A strategy. So there are different strategies that we kind of run because it's the mandates are slightly different. That's how the fund management aspect of it is. And I like I mentioned earlier, we have a 22-member research team, which is there, India's largest coverage within the country with 490 stocks under coverage. These 22 analysts basically feed into feed research to us, and from there, wherever we need a little more deeper work, two of our analysts, Sandeep and Manan, also do slightly more deeper work where required, and then we go through this process that I kind of mentioned in terms of the 5-stage process, which includes the BMV, and then build the portfolio. That's typically how it comes across.
Sure. The other thing is, you also have your mutual fund business, which has been into existence for 25, 30 long years now, and we've heard Naren, very vocal about valuations, and he keeps a very strong track on that. So my question is, when the other side, when I look at PMS, when I look at your portfolio, I don't know, would it be right to say that it is in the same line of the way mutual fund is being managed, or it is absolutely different? There's a big Chinese wall in between, or you say that they are conservative, we are aggressive. How do you want to look at this?
No, there are multiple ways, right? Typically, what happens is the way you kind of run a portfolio kind of gets decided by the set of investors that you typically have. So, if you were to kind of look at mutual fund, for example, you typically have investors who invest between 500 rupee all the way down to multiples of crores. So there's no homogeneity. So to that extent, you typically run it for the smaller investor. So typically for 1,000 rupee or 2,000 rupee investor. So your risk management and typically you tend to do is the way you kind of run it is a lot more risk averse. So it tends to be a more benchmark plus or minus strategy to a large extent. People don't take as much active calls as much as required. But when you actually look at what's really happened with regards to PMS or AIF, typically that because of the ticket size, there's a lot more homogeneity in the set of investors who've kind of historically, when you kind of look at other markets also, when the affordability levels kind of increase in the market and the affluence there is a requirement for a slightly higher active risk to be taken and active return to be generated. That's where somebody who can run a boutique portfolio kind of comes in, and that's where we've kind of set up a slightly different team for this aspect. While some things might be common between say for example the mutual fund and us, there are quite varied calls. So today, for example, if you look at the portfolios for us, pharma is not really a big overweight for us. It's a big overweight for the mutual fund. IT again, we are literally zero in Contra. In the mutual fund, while they are underweight, it's not by that big a margin that they are underweight. Energy, for example, we are really not there. It's one of the top holdings for them, in that sense. So to that extent, there is, and the other construct that we kind of always stick by is, typically in a mutual fund, you'll ideally find between say 45 to 90 stocks or so. Here you find a very, very curated portfolio of, between 25 to 30 stocks, and the active shares are pretty high. So you find between 75 to 99% of the three portfolios that we're discussing here. It's a pretty high active share that we're taking. It's the active return that we're taking. Active risk that we're taking to generate active returns.
Sure. While I had a brief call with Anand last time, and in fact happened to got a chance to interview him and read his mind about Contra. But maybe my last question is, if you can talk to us about how are you running and positioning your Contra fund, and what is it that you're contrarian about at this point of time?
So even today, for example, in the portfolio, I wouldn't look too much on the left side of the this thing, looking at the stock names, because you might say what's Contra about owning some of the large franchises in the country. But if you actually look at the second bucket, which is where the sector orientation is concerned, literally 50% of the index is really not here. Which is IT, pharma, energy, consumer staples, consumer discretionary, auto. All these sectors are not there at all. It's not that there are not good companies within these sectors. It just so happens that there is better risk reward in the other segment of the market. So when there are, Vikas, I think your line is muted. I think you're trying to speak something.
Yeah. So I was saying that on the second table that you said, these are the businesses that are beyond benchmark, right?
Yeah.
Over to you.
Yeah. So, which is where we kind of see that, again, the sector orientations are completely different. That's one. Second, where we are completely different, for example, say, metals, for example, is not as big an overweight at, which is a pretty large contrarian position. Being completely zero on IT is a contrarian position. Being completely zero on pharma is a contrarian position. Within financials, being underweight on non-lending financials and NBFCs is a contrarian position. Within consumers, again, being overweight on by as much as 9.5% on telecom across the two companies there, and being overweight on real estate. These are, I would say, and industrials orientation within the portfolio is also pretty large. And within financials also, the orientation towards public sector banks. So, for example, public sector banks here is roughly about 13-14%. That's not the weight that you'll typically find in any sort of portfolio any normal portfolio that you kind of come across. So those are areas, and there is a fair bit of PSU representation within the portfolio. So these are areas again which you'll normally not find in a normal portfolio.
Sure, great. It was pleasure talking to you, Chockalingam. I think you've clarified most of the points so patiently, and I must give you compliments on behalf of entire AIF and PMS team. The way you identified the trend, the way you were early on in terms of selling those special chemical businesses of India, the way you looked at IT, reduced your exposure, and then came back and increased your valuations after it fell down. I mean, it requires different sort of expertise. So compliments to you and your entire team. Many thanks. All the investors are happy. So continue to create alpha.
Thank you. Thanks, Vikas, and thanks a lot to you and your team for the support shown. Looking forward for more long-term association. Thank you.
Thank you. Thank you once again.
Thank you.